All right, welcome to Module 2, Uncovering Market Madness, Understanding the Market and the Movements. I'm Jason Whaling, founder of the Wealth Titans, full-time investor and entrepreneur. So welcome to Module 2. And in this module, we are going to cover the big picture of the markets. Now that we have an basic understanding of the markets and kind of how they work, we're really going to dive in and look at the markets to gain a comprehensive understanding of why it behaves the way it does. Really digging into why do the markets move up and down? Why do they move up and down so much? Some days it seems like it's a teenager with mood swings, and the other it seems like a grandpa just sitting in a chair. So let's dive right in. How are stock prices decided? Share prices change every day due to a countless number of market forces. With share prices changing multiple times per second with some stocks, it's important to keep up with the market movements as a non-professional. It's important, and it's also impossible. So this is, when I say important, I should have clarified that this for traders. If you're trading, it's important to keep up. If you're investing, it's not important to keep up. Sorry about that. Of all the forces that move and manipulate the market, the rudimentary economic principles of supply and demand really are the strongest at the end of the day. When lots of people are interested in buying a particular share, the demand for that share goes up and the price of the share moves upward proportionately. When many people are selling a particular stock, the supply exceeds demand and the share price drops because there's more sellers than buyers. While it's easy to understand the basic principle of supply and demand, it's very difficult to find out why people decide to buy a particular stock and sell another. If you decide you want to learn to be a trader, this is really what you're going to be doing the majority of your time. The why is important to you as a trader and will be a large part of your trading plan and methodology. Because when you're trading, you're competing against other traders. So it becomes all about behavioral finance and understanding how other people are thinking and trying to predict their moves. For investors, it's a heck of a lot easier. The why isn't all that important since your focus will be on the operations and health of the company rather than what the current market sentiment is that's driving the current stock price. Now, we could spend an entire course attempting to list all the different factors that move the markets. So we'll just touch on three most common factors that influence non-professional investors to make their buy and sell decisions. As cynical as it might sound, professional traders are often on the opposite side of non-professional traders, buying when the public is selling and selling when the public is buying. And we'll look into how this works out in a bit. The easiest way to find out whether people are going to like or dislike a stock is to review current news about the company of the stock. If any news is favorable to the company, then the positive sentiment will most likely be present in the market, pushing up the share price. However, when news is adverse to the interests of the company, the negative mood will set in and the price of the share may come down. Now, there are different times where the good news and bad news won't move the stock at all, and that's because people already assumed the news was going to be bad, and so the market has already moved on that bad news, and vice versa for good news. This is true because in the short term, news developments have the greatest impact on share prices, and you can use this to your advantage without having to learn any complex or convoluted chart patterns. Now, this may seem like an oversimplification of determining how the general market moves and what the sentiment is. However, the reality is, unless you devote hours a day understanding the full implications of the driving factors behind a stock's price movement, this is the most practical approach. I do have a quick warning to aspiring traders. Here's the harsh reality you and I face as traders. Professional traders will be in and out of a trade by the time the news comes on. The professionals set their trade before any news reports hit CNBC or Bloomberg TV. In fact, they use news to exit their trades. When the general public decides it's a good idea to jump in, they pay thousands of dollars a year. The professional traders pay thousands of dollars per year for news sources that will give them the inside scoop before anything hits the TV, in addition to their great knowledge base of how to do in-depth research to beat the news stories, which keeps them a step ahead of the general public. For this reason, if you plan on trading, don't expect to strike it rich trading the news. Next, we have company earnings. One of the major news items that an investor and trader should watch for, more so trader though, just short-term investors sometimes watch for this, is company earnings reports. Earnings are normally reported on a quarterly basis, and these companies release these quarterly financial statements and then one big one at the end of the year. The price fluctuation of a stock's price will peak during the periods where traders anticipate good news or bad news on these earnings. And these are sometimes called earnings plays, where traders will look and try and predict what the earnings are going to be, and the market price will fluctuate a lot around those times. Now, in most cases, the company's earnings announcement is only half of the picture. The earnings numbers only matter in the context of analyst estimates. However, the reports are only the result of the end of a big guessing game, because the real driving force behind the stock's price around the earnings is the analyst expectations of the earnings. So when a company says, hey, we're up 500,000, that 500,000 is only good or bad in the context of analyst earnings. If analysts think that they were going to be up 700,000, then it's bad news. If analysts thought they were going to be up 300,000, then it's good news. So just keep that in mind. It's what they call earnings plays. When traders play earnings, they are looking at analysts and saying, what is the expectation? And thinking if the expectation is going to be right or wrong, as opposed to whether or not the number that comes out is actually good for the company. All right. And finally, we have analyst projections, which is very similar to what happens with earnings. Analysts usually predict the amount of profits or losses that a company will make. These predictions are the real driving forces behind the stock's price movement around these earnings. This often results in a strange phenomenon. More often than not, when a company meets its earnings projections, little happens because the expectation of positive results has already been factored into the stock. Those who bought were just waiting to be right, or sell to those who are buying at the last minute before earnings are announced. On the other hand, when a company's earnings fall short of expectations, even if it's just a couple of pennies, and I mean pennies, sometimes just 1 penny, the price may drop like a brick just because expectations weren't met. And this brings us to volatility. So what is volatility? And this word volatility is most arguably the most overused word when it comes to financial news. Simply put, volatility is a measure of how much a stock's price moves. It's just a measure of price fluctuation, how it goes up and down. The higher the volatility, the greater the typical price range or fluctuation of a stock. Since it's measured in different ways, I want you to think of volatility as the standard deviation of a stock's price. Remember that when you average data, the standard deviation gives you a measure of how accurate the mean or average is. So if the standard deviation is 2 and the mean of your data is 5, it means that the average is 5 plus or minus 2. In our case, we see that the stock price is the mean, 5, and volatility is the standard deviation, 2. So when you're looking at the price movement of the stock, as long as the price is between 3 and 7, it would be considered normal because both prices are within the volatility range. So this volatility range, or the trading range, would be 3 and 7. We expect the price to go between 3 and 7. If it breaks above 7, then we have something called a breakout where we think, ooh, maybe something's really different and it's going to go higher. Or if we have go below 3, we think, oh, something bad came out. This isn't normal. So the 3 to 7 is kind of what you would consider normal. And by the way, a 3 to 7 price fluctuation for a stock is really high. So this is just an example. Volatility is not the same as risk as many financial sites and common people think. Yeah, that's a nice way to put it. Stocks that are more volatile are often considered more risky, but volatility itself is not a measure of risk. And that being said, this is just a giant misunderstanding. What market volatility really represents is one of the main reasons investors tend to sell at the wrong time over a period of time and fail to benefit from their investment. And a good understanding of this principle causes volatility to alleviate many fears. As an investor, volatility isn't a metric that you should be focused on. It's a measure of short-term price movement which shouldn't matter to an investor with a 5 to 10-year timeline. Traders, on the other hand, live off volatility. They need volatility to trade. They need the stock price to move up and down to trade. After all, you can't trade if prices aren't moving. So to really hound in this point, real risk lies with the investor. And that's a direct quote from Benjamin Graham. He was Warren Buffett's teacher. The Intelligent Investor is an excellent book. If you want to know how to invest on your own, you can go read that book and you're set. You will have read the source material of most of the investing tactics and insights of today. And volatility does not mean risk. Volatility simply means opportunity. Traders use it to make a lot of money, and investors can use it to time their entry points and really ramp up their investment gains. You're still looking at a 5 to 10-year time horizon, but you can use volatility to your advantage. So volatility does not equal risk. The risk lies with us as investors. The more we know, the less risk our investment will be, and the more we can use volatility to our advantage. All right, so here are the causes, some of the causes of volatility. Periods of expansion and contraction of new investment dollars into a stock due to effects of a volatile economy or changes in an analyst's economic outlook, anticipation of companies' earnings announcement, and finally, stock market. Finally, we have to remember that the stock market is emotional and it overreacts to movements of fundamentals of underlying businesses and seemingly unrelated in the company or the economy, and also hype. Maybe they just read about a stock in a newsletter and they think it's going to be the next greatest thing and they jump in. And you'll notice that the causes of volatility are very similar to what moves the markets, because the market as a whole has a measure of volatility as well. Volatility is just a measure of how things move up and down and how frequently and how fast they move up and down. So all of these factors push into how volatile the markets are, how much they move up and down, and then how volatile individual stocks move up and down. Oh, and quick insider tip. 3 out of 4 stocks tend to follow the market. So this is why using broad market indexes like the S&P 500 or the Dow Jones average is really helpful, because if you're investing in a stock, you'll know that you have a 3 out of 4 chance of it just following what the general market is doing. Fun fact.